Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back with you with our weekly wrap-up. Graham, there was quite a bit of drama going on in the market last week. What can you tell us about that?
Yeah, it was, Stacy. I think that's kind of putting it lightly, right? And it carried through the weekend. So we kind of had two things going on. We had the Federal Reserve stepping up, being quite a bit more hawkish, at least in their testimony, that they might have to keep rates higher for longer to bring down the stubborn inflation. They're going to do what they have to do, they said, to bring it down. Also, at the same time, we saw the 16th largest bank fail. And the government, the FDIC, have to step in and secure these assets for the depositors. Now, we haven't seen this since 2008. So you can imagine the fear and the anxiety, and rightfully so, that this bubbles up with what's going on in that regional side of the banking industry with Silicon Valley Bank. So we really saw some volatility. We really saw the markets really give back most of the returns that they've had this year. If we look at the returns in the market or the lack of, we saw the Russell. So the Russell 2000 small cap stock area, about 25% of that indices is made up of financials, regional based. So we really saw that pull back about 8%. We saw the NASDAQ and the S&P pull back about 4.5%. And I know this is stating the obvious. What was the biggest criminal in that drop? Well, it was financials. For the S&P, they were off about 8.5%. Now, again, it's fear, right? And that's kind of running throughout the whole industry. And what effect, if any, it could have on other regional banks and other large financial institutions in the contagion, right, that it could have. So at the same time, it might have brought bank stocks down or stocks down. We really saw yields really tumble on Friday, and probably going to carry through in terms of the downside, because that's the fear trade, right? You come out of equities, let's go into these government-backed or solid bonds, and that's what we're really seeing. We're seeing yields really drop. We're seeing bonds really have some pretty stout rally. February payroll did increase by 311,000. We did see some muted wage gains. If we're looking at some economic numbers that came out, we did see the unemployment rate tick higher a little bit. So maybe that could take a little bit pressure off the anticipated Fed effect. U.S. factory orders did decline in January as demand for transportation equipment and durable goods as it fell. Internationally, we saw the Bank of Canada really become the first major central bank to pause rate increases. The Reserve Bank of Australia hinted at maybe pausing their tightening policy after they raised about 25 basis points. And oddly enough, through all this drama, the inevitable recession maybe isn't happening in Europe. We had the UK really reverse December's contraction with a slight gain of 0.3% on their monthly GDP. So we'll have to see how that shakes out.
Okay. Well, Graham, you mentioned that what happened with Silicon Valley Bank has not really occurred since 2008. Is this something that we should be concerned about, like another 2008 happening for us?
No, I absolutely don't feel that's the situation. Now, is it something to be fearful of? Should we be mindful of it? Could there be an issue that we need to address? Absolutely. I think the government, the FDIC, they're already doing that. They're already taking steps. But this is not the same thing as 2008. I want to make that real clear to our viewers. But it doesn't mean it's not causing a lot of anxiety and volatility, certainly in that financial sector. So not 2008, but definitely something to be concerned with. Actually, it might turn out to be a positive. What if this puts enough pressure, right, on the Fed that says, hey, maybe we need to pause our rate tightening stance. Maybe we need to be a bit more mindful about the cracks that we're seeing in the financial system, or at least with the regional banks, these specialized regional banks. and maybe pause here and see how things are going. And that might be extremely good for stocks, high growth stocks that got hit so much. And obviously, we're seeing it carry over in yields really pulling back as bonds are rallying.
Okay. Well, do you have any recommendations for our viewers on how to handle their fears and concerns surrounding this event?
Yeah, and I would say understand the situation right now is contained with very specialized banks that were doing specialized things for specialized clients, right? And it doesn't mean it's pervasive. It doesn't mean it's a contagion, right? And it's not 2008. Often things I think about, what does Silicon Valley Bank have to do with Coca-Cola? What does it have to do with Deere? Now, everyone's going to be affected. Everyone's going to get wet, if you might, when it rains. But not necessarily at the same degree. So I think level heads or having a level head is the place to be. Overreaction, absolutely do not overreact. Let's give this time to kind of work itself out. Expect some volatility in the market. Again, this might be a very good thing to set us up for some more positive returns down the road.
Okay. Well, thank you so much for that information, Graham. Thank you to our viewers for joining us today. We will see you again next week on our weekly wrap up. And until then, have a great week. Take care.
Take care.